There's two schools of thought on how to enter into an investment. There is the school of thought that it's more important to put your capital to work at all times, as much of the time as possible. And that group believes that the time that your capital is in the market is more important than trying to time your investment in a particular stock or bond or whatever it be. And it really is two different approaches. A time in the market approach is supported by value investors like Warren Buffett, who believe that certain investments take a lot of time for you to get the value that you were looking for. And sometimes you buy into companies that are in a turnaround situation that need to repair their businesses and make them thrive again. Timing the market probably gets more of the headlines. You see, really great investments. The Big Short is a movie about somebody who shorted, the subprime market and made billions. It's great that he did that. Just a brilliant guy. What I would say that it takes a lot of analysis, and it's a big risk to time the market, like the case in The Big Short. Let's get into these different philosophies, and at the end, I'll reveal which one I subscribe to. And I'd like to ask you to comment in the comments to tell me which one you are. Are you more of an investor that wants his or her capital in the market for a long time? Or are you trying to time the market and really hit a home run on a particular investment? You can be a successful investor in equities using either approach. Warren Buffett arguably is the greatest value investor of all time. He started investing when he was a little kid, and he started investing as a young man. And he's in his 90s. So he's had a lot of years to really hold investments and make lots of money. And he really has held, investments for a long time. So he's a great example of the type of value investor that one can become over time. There's another really brilliant man, George Soros. And what he did, and he took opportunities in the marketplace and he timed certain investments. He shorted the pound sterling and made billions. He's shorted or made certain investments in certain times and just really hit home runs. But I haven't heard of George Soros, breaking any new records or really hitting home runs recently. I'm not taking anything away from him. He's a brilliant man and made a lot of great calls. But it's just two different approaches, but you can be successful with either one. It's just really about picking, which one you want to be, which one is going to fit the type of mentality you want, the stress level that you want to have. So let's get into the differences between one or the other. So with the time in the market mindset, you're a disciplined investor over time. You're putting money into an investment or a portfolio of stocks over time and watching that investment grow. You're long-term oriented. You're not looking for a return this year. You're looking for your portfolio to grow, and maybe you want it to double in the next 5 years, and that'd be a good goal, and you want to see it through. You're a builder. You're building something that is going to have a strong foundation, and you're going to build it over time. On the other hand, timing the market, you're more of a risk taker. You're betting, big on a particular stock, or you're betting that the market's going to go up significantly. And you're really timing the way that you invest your capital. You're probably focused on shorter term results because you're seeing that you made a bet that, let's say, Netflix is going to go up in value and it's going to go up by 30% by the midsummer. So you're going to see that through. And if it indeed goes up, you sell. Or if it doesn't go up and your hypothesis is incorrect, then you sell. So it's a shorter term mentality that you have. If you're timing the market, your research is critical. Your instincts have to be accurate. So that type of mindset, you have to be do great analysis, be a great researcher, and really know all the variables that exist for that bet you're making. The S&P for the last 100 years or so, little less than 100 years is shown here on this chart. It's had years where it's had great appreciation. It's had years where it's had, negative returns. If you look at the Great Depression, you had 4 consecutive years of negative returns. It must have been just a terrible time to invest in those days. But then afterward, you had years of more than 50% S&P returns. So whoever invested here, continued to invest, really did well. Now, more recently, if we look at 2022, it was a negative year for the S&P. It was a pretty good negative year. And, I don't know that this year, 2023, is going to be a negative year. I would guess that we're going to be near even, maybe slightly higher, maybe slightly lower. I would be surprised if we were significantly higher or significantly lower. But if you look at the drop in 2018, it was a small drop. If you recall, toward the end of the year, stocks really were sold off, maybe for tax loss harvesting, but it went down. The subprime, meltdown, that was a significant drop of 38% in 1 year, big drop, but it was followed by really boom years in the S&P. And then the dot-com bubble, that one did last a few years. I think valuations, if you look at the previous years to it, you had 5 years of just boom, period. And there was a lot of, there truly was a bubble, especially in tech stocks. So it took a long time for those to recover. But it's very difficult to know, is the down cycle going to be 1 year? Is it going to be 3 years? Is it going to be 2 years? It's very difficult to know. If you're good at picking the moments and knowing when it's going to rise, great. You're going to do great timing the market. But over time, you see a lot more blue than you see red. Your time in the market is going to take advantage of all these years that the market's up. And I subscribe more of, I want to be in the market because in most years it goes up significantly. And I want my equities to go up in value when the S&P goes up. Here's why I found that timing the market could be really difficult. This is the last 5-year chart for the S&P. And I want to focus in on around the time when COVID became a big issue. The pandemic, we realized that we had to go on lockdowns in the US, and the economy really, in many industries, grinded to a halt. Well, the S&P just dropped significantly, and picking that bottom would have been incredibly difficult. I was having a hard time. I did not sell any of my equities at this moment, and I continued to buy into the market. I continued to buy stocks, and I actually increased my research and homework that I was making on companies to see how are companies going to be affected? Is there opportunities to take advantage of? Now, getting my money out and putting it back in, I just cannot fathom that decision because it's so difficult. We didn't know if COVID was going to last, make the economy go into a depression that would have lasted, 2-3 years. That was unknown. But the economy, did get back on its feet. The Fed Reserve put a lot of stimulus money into the market, and the markets recovered. But certain industries didn't immediately recover. For example, travel stocks were just destroyed in 2020. Oil prices, believe it or not, hit zero. And Chevron and Exxon and oil companies really went down in 2020. So it was very difficult to pick, when the top existed and when the bottom was going to hit. So I found it to be safer for me to just keep investing. And I'm glad I did so, because I bought stocks at a discount for that short period of time. Now, I didn't hit any home runs there. I did buy a few stocks that I thought were going to do well over time, and the market had wrong. One of them is Chevron. I knew oil prices would rise again, and I bought more Chevron. I've been a Chevron stockholder for more than 25 years. So I bought more Chevron. I also bought Big Five Sporting Goods at $2 a share in the spring of 2020, and it went up to $40 a share at one point. There was the stock, just kept going up. Within 2 years, it had that type of return. So I did really well in those two stocks, and I could say that I was timing my investment on those two occasions. But overall, 90% of my behavior during these drops has been to really just be that time in the market investor of continuing to put capital into the market, because my confidence is that over time, we will have more years in the positive than we will in the negative. And I'm not smart enough to know how long these recessions are going to last, or how many years the S&P will go negative. So instead, I want to bet on the overall long-term vision that the markets will rise more years than go down, and I want my money in the market. It's an interesting study that Charles Schwab, that brokerage, put out, and it shows the returns. This was over a 20-year period from 2001 to 2020. And this is if an investor was brilliant enough to execute perfect timing, and then on the other end of that spectrum, the investor just stayed in cash and just kind of earned interest. And then in the middle were somebody who just invested immediately. Let's say 401k automatic deductions. They already had, hey, each paycheck, I'm going to put 10, 15% of my money, and this is how I want it to be distributed among my investing selections. And then there's dollar cost averaging, which is similar to that, where you're just buying the same investments over time, and you're not doing a lot of research into them other than knowing that that's a company you want to be invested in. And then there's bad timing, where you bought into stocks, but the timing wasn't very good. And what I found to be interesting was the difference between perfect timing and just investing immediately, or dollar cost averaging, was very close. The result ended up being fairly close. I would argue that executing perfect timing is incredibly difficult. And many times while you're waiting for that perfect, time to buy, your money's in cash. So that's why, it's just slightly higher than investing just more with discipline, with a long-term perspective. And again, perfect timing, I would argue, is near impossible, very difficult to have over a long period of time. Some conclusions on, the two different schools of thought, time in the market versus timing the market. So time in the market, you're building inertia, you're building momentum, month after month, quarter after quarter, year after year, decade after decade. You just keep getting better, and you're growing the value of your portfolio. So with that, you're using time in your favor, and you're using dollar cost averaging so that I want to be an owner of Chevron in my example, and I want to own Chevron over time. It's been a great investment. I've done really well with it. They pay a great dividend, and I continue to buy Chevron. I've been buying it for 25 years, and you use time in your favor. It's lower stress. You know that over time, markets will rise, and you will over time win. You will over time make a very good return. So that's the mentality of time in the market. Timing the market is far more exciting. You're chasing big returns. You're not looking for, a marginal, return, maybe with a little bit of upside and a dividend. No, you're really seeing that there's an imbalance in the marketplace. Somebody doesn't understand a company, but you do. and you believe it's going to rise significantly, or you short the stock, but you're looking for big returns. Your research and insight is critical. I would say the homework behind a big bet has to be, 4 to 10 times more. And it's more stressful. If you make a big bet and you're expecting a company stock to go up or down in a short period of time, I believe it's more stressful, at least the type of person and investor that I am. It's more stressful because you could be wrong and you could lose a significant amount of money. So those are two different, schools of thought. Now, I'm not strictly one or the other. I would say that most of the time I am a time in the market investor, and I want my portfolio to grow over time. There's certain stocks that I've owned for a long time, but on occasion I time the market. When the market goes down, for example, in 2020, I was buying into the companies that I really want to own. And, in a way, I was timing the market thinking I'm getting more shares at a discount. Other examples are I took advantage of the Netflix drop. They dropped 75% they began to drop in 2021. The drop finished in 2022. But I started buying in when I thought that stock is discounted. It just dropped too much for the number one streaming company, and I was right. And within 5 months, I cashed out that position and made a 40% return because the stock for Netflix rose very quickly, and it rose above the intrinsic value that I calculated for Netflix. So I was able to really reap a really nice return. And then, that was timing the market. But I would say 90% of the time, maybe 85% of the time, I'm a time in the market, investor. And I do take certain situations, although they're seldom, and I time an investment that I want to make because I do believe that a certain company is undervalued and is going to have a big return. So that's the type of investor that I am. I'd love to hear from you in the comments on the investor that you are. Are you more of the time in the market investor, or do you like timing the market and making big bets? Please comment and let me know which one you are. Love to hear from you and see the type of investors that are watching these videos. Thank you for watching the video. I hope you found it interesting and it gave you something to ponder, something to think about, and see the type of investor you'd like to be. Thanks again for watching, and good luck investing in 2023.